Friday, November 9th. Go Golden Buffaloes, I hope. The election thingy, interesting response. On first blush, it looked as though the election was not a blue wave, it was a blue dribble. But the aftermath is fascinating. The first response in the financial markets was a great big day in the stock market, and interest rates rose on the assumption that the election meant that a business-friendly administration was safe. The Wall Street Journal editorially, interestingly, thinks the Democrats did better than the Democrats think they did. And so the stock market is now unraveling. Order was restored by the Fed on Thursday, reminding everybody that they're going to add a quarter point to the cost of money in December, and they're going to do it again until the economy slows down. There's some movement at the Fed to stop at perhaps 3%. The Fed is right now 2.25%. It will go to 2.5% in December. The prime rate is 3% higher, so prime will go to 5.5%, which is going to come as an increasing shock to all sorts of people. Mortgage rates have gone up again, not much. We saw quotes today at 5.25%. Something technical. The spread between the 10-year Treasury note and mortgages has widened. Not much, but after years at a pretty steady 1.8%, is now between 1.9 and 2, and may have to do with the Fed's allowing mortgage-backed securities to run off of its portfolio. It's not serious, but the shock factor is beginning to affect housing. Not so much in red-hot places like here, although Seattle's numbers are instructive. Seattle's year-over-year sales are down big, and their inventory for sale has doubled year-over-year. Here in Metro Denver, our inventory is up about 35%. Most of that change is just since summer, and so I think interest rates are beginning to bite into the economy. I am a fan of the Fed. What it's doing, I'm in support of. The Fed always overdoes it, and we always discover it in retrospect. And this is not a prediction, it's just a notation about data, that things began to soften really late summer. One of them, credit card balances outstanding, fell in September for the first time in a long time, and the trend in those balances has been down. So there's something going on out there. My wishful thinking overtakes my judgment in hoping that we have reached a top for mortgage rates, but I think we're close to it. Another long-term historical marker is when mortgage rates rise 2% from the bottom of the previous cycle, rise 2 percentage points, we have a recession. We're close to that. We're within about 0.25%. Another shock to consumers, the Fed pushes up on short-term interest rates. And short-term interest rates are the ones that define where adjustable rate mortgage payments go. And so I got calls this week from 3 different adjustable rate mortgage borrowers who basically had forgotten that they had them. And they've gotten payment change notices to just about 5. And I've been through this before. Young people haven't been through it, but I've been through it several times. So I have to explain to them, they think I'd like to refinance and get something better and not have to go through this adjustment. And I've had to explain to all 3 of them, one just an hour ago, that, well, you're adjusting to 5 1/8, and we could get you a new 5 1/8 30-year fixed rate loan. I said, well, why don't I do another adjustable and get a lower rate? I said, well, we could do one of those, and without points, that would be 5. So the only reason to refinance from one of these things is to stop the prospect of future rate adjustment, but you won't do better than you have. So the question then is, how far up does the Fed go pushing LIBOR and 1-year treasuries, the commonplace indices for adjustable rate mortgages? How far does it go? Is it worth paying $3,000 in closing costs to refinance just to stop the prospect of going to 6 something next year? And all three customers are surprised. I suspect that they might begin to limit household spending after the conversation. And none of the three knew what to do. All three this week, armed with options, are going to think about it for a while. But their house payment in each case is going up 2 percentage points this year from last year. That's how the Fed slows the economy down, by raising short-term interest rates. On that not so necessarily happy note, Sunday is Veterans Day. Used to be called Armistice Day, after the World War I armistice on the 11th hour of the 11th day of the 11th month. 100 years ago this weekend, 100 years ago on Sunday. In the newsletter posted near this video, at the end of it I reprinted two of the great British poems that came out of the war. The British poets were extraordinary, and the one which I get the snuffles every time I read it. Wilfred Owen wrote Dulce et decorum est, how sweet it is to die for one's country, and which of course it's not, and the poem is tough. And Wilfred Owen was killed in action on November 4th, 1918, a week before the armistice. Very little attention's been paid to the 100th anniversary of the First World War. Give it a minute on Sunday. Thank you very much. Good weekend.